Lesson 2. Consolidate your payments. Are you wondering whether you should consolidate your bills? Depending on the method you use, consolidation might help you save on interest and get you out of debt faster. It can also provide the convenience of one monthly payment instead of many. Debt consolidation entails taking out one loan to pay off many others. This is often done to secure a lower interest rate, secure a fixed interest rate, or for the convenience of servicing only one loan. Debt consolidation can simply be from a number of unsecured loans into another unsecured loan, but more often it involves a secured loan against an asset that serves as collateral, most commonly a house. In this case, a mortgage is secured against the house. Collateralization of the loan allows a lower interest rate than without it, because by collateralizing, the asset owner agrees to allow the forced sale, foreclosure, of the asset to pay back the loan. The risk to the lender is reduced, so the interest rate offered is lower. Sometimes, debt consolidation companies can discount the amount of the loan. When the debtor is in danger of bankruptcy, the debt consolidator will buy the loan at a discount. A prudent debtor can shop around for consolidators who will pass along some of the savings. Consolidation can affect the ability of the debtor to discharge debt in bankruptcy, so the decision to consolidate must be weighed carefully. Debt consolidation is often advisable in theory when someone is paying credit card debt. Credit cards can carry a much higher interest rate than even an unsecured loan from a bank. Debtors with property, such as a home or car, may get a lower rate through a secured loan using their property as collateral. Then the total interest and the total cash flow paid towards the debt is lower, allowing the debt to be paid off sooner, incurring less interest. Because of the theoretical advantage that debt consolidation offers a consumer that has high interest debt balances, companies can take advantage of that benefit of refinancing to charge very high fees in the debt consolidation loan. Sometimes these fees are near the state maximum for mortgage fees. In addition, some unscrupulous companies will knowingly wait until a client has backed themselves into a corner and must refinance in order to consolidate and pay off bills that they are behind on in payments. If the client does not refinance, they may lose their house, so they are willing to pay any allowable fee to complete the debt consolidation. In some cases, the situation is that the client does not have enough time to shop for another lender with lower fees and may not even be fully aware of them. This practice is known as a predatory lending. Certainly, many, if not most, debt consolidation transactions do not involve predatory lending. Interest rates haven't been this low for decades, tempting some consumers to take on additional debt to ease existing credit woes. The goal is to consolidate various higher interest balances into one easier to handle and less costly package. But be careful of what looks like to be a quick fix. You're getting symptomatic relief, not a credit cure, says Chris Weil, General Manager of Cambridge Credit Corp, a nonprofit credit counseling agency based in Anawam, Massachusetts. This fighting fire with fire approach can take several forms. There are debt consolidation loans, balance transfers to a 0% credit card, and home equity loans or lines of credit. But, says Weil, 70% of Americans who take out a home equity loan and other type of loan to pay off credit cards end up in the same, if not a higher, debt load within 2 years. Weil's statistics underscore a major problem with debt consolidation. It feeds upon the tendencies that got you into trouble in the first place. By taking on yet another creditor, you're adding the proverbial fuel to the fire. In this case, it's your money that's burning. Plus, if you've taken on so much debt that you're looking for more as a solution, chances are you won't qualify for the very low interest rates you see advertised. Those generally go to the people with stellar credit ratings. However, if you're at the end of your credit rope, or swear that this time you'll be more disciplined, debt consolidation may be something to consider despite its risks. Here are some popular forms of debt consolidation, how they work, and a look at their pros and cons. Home equity loan or line of credit. Home equity lines or loans are often touted as a quick and easy way to get out of debt. By leveraging your residence value, the pitch goes you can get money to pay off your bills and a tax break too. But borrowing against your house can backfire. The biggest risk, you could lose your home if you default on your loan. Some hardship occurs and now they have double the debt, and if it's secured by their home, they could lose it, says Diane Giriantano, Director of Education at Garden State Consumer Credit Counseling in Freehold, New Jersey. And while equity loan interest generally is tax deductible, it could be limited in some situations. Even when it does provide a tax break, Cambridge's Vial says, that doesn't mean it makes fiscal sense. Giriantano agrees. Banks will tell you how much you can borrow, she says. That doesn't mean you should borrow the total amount, but that's what people do. Still, a home equity line of credit or loan to pay off creditors can work for some debt-burdened homeowners. Just be sure to do your homework to guarantee that the home equity dollars and cents make sense.